this could be you.
Come to my seminar! The life of your dreams is only good to see you again, George!
Not that part, but here you are sitting on your tail feather, money in the bank earning interest. Actually, sitting in the bank losing money when you could be earning passive income through dividends. If you want to stop living on pennies and start earning some real cash, this video will teach you what you need to know to make all of that in passive income. Hey yo, what's up everybody? I'm Sean McMurray and this is my channel Analytical Overdrive, where we talk finance, stocks, real estate investing, and cryptos. My current strategy for investing has always been to buy low and sell high, which has been a relatively medium-term investment strategy looking to make the most amount of money in the shortest amount of time possible. And yes, while this has enabled me to turn $1,000 into $45,000 in 3 years, it's also a very time-intensive investment strategy, as I need to be constantly monitoring not only what's happening in the market, but all around the world, since as we can see, the rapture has been let loose in 2020. With $10,000 saved up, I wanted to dive more into a longer-term strategy that would ease up the need for constant monitoring and earn me more of a passive income so that I could be doing this. All while money cha-chinged into my bank account.
Winning.
In this video, I purposely left out the deep dives into the technical aspects. This is more of the
Take it easy.
explanation of dividend investing. It's great information and exactly what you need to understand. The easy way for you to start making money in dividends today. No fluff, no frill, keyword, easy. For those of you who care about the technical aspects of dividend investing, as I do, let me know if you'd like me to do a technical deep dive in the comments below. So before we get started, you first need to understand what dividend investing is. The very simplistic explanation is that some companies will pay you a portion of their earnings simply for owning their stock. We call these dividend payments. Companies will make these payments monthly, quarterly, or on an annual schedule reflected as a percentage per share or dividend yield. Not all companies pay dividends. This is usually offered by more mature companies whose stock growth has slowed to entice investment. For example, Google does not pay dividends while Coca-Cola does at a 3.53% annual yield. Amazon does not pay dividends, but AT&T does at a 6.93% dividend yield. You can figure out which companies pay dividends and how much easily. Google this: name of company stock, price, and look for the dividend yield. It literally doesn't get any easier than that. It's about as easy as sleeping. You can do it with your eyes closed. Now that we know what dividends are, let's talk about everyone's favorite topic: taxes, baby. It's important we talk about taxes when it comes to generating passive income in dividend investing. If your goal is to retire young or make as much money as quickly as possible, taxes will be the single most prohibitive hurdle towards that goal. Understanding how to minimize your tax exposure is the difference between Uncle Sam taking 0% or up to 37% of your profits. Think about that. That's 13% shy of half of your hard-earned money gone. When it comes to taxes on dividends, you are going to fall into one of two brackets: ordinary dividends or qualified dividends. Ordinary dividends are taxed at a standard federal income tax rate, while qualified dividends are taxed at a much lower rate. The basic formula for determining whether your dividend is qualified or ordinary is if the shares are owned for more than 60 days during the 121-day period that begins 60 days before the ex-dividend date, then the dividend is qualified. Otherwise, it is not. Yeah, that was about as easy as telling a story about your sister's boyfriend's mother's cousin who lives with his mama but rents an apartment downtown. Though I get it, I'll keep it brief and say, hire a tax advisor and let them figure it out. Now, let's talk about my purchases, my strategies, the potential upwards trends, and the beautiful thing called compounding interest. This, folks, is my dividend portfolio. My $5,679 investment into dividends is making me a whopping $301 a year just for owning these stocks. Yo, this excites me, but I get it. $301. Womp, womp, womp. You're not retiring or quitting your job on $301 a year. But this is only part of the equation. Keep in mind, you are making a 5.3% return on your investment, which beats inflation and any interest that a bank will pay you for keeping your money in a savings account. In addition, you are not taking into account stock appreciation, which has averaged out to 11% growth annually for dividend stocks, equaling an average of 16.3% return on your investment. Woo! Yeah. Now, here's the magical part of dividend investing: compounding interest. Compounding interest is the interest earned on your original investment plus all the interest earned on the interest that has accumulated over time. Racks on racks on racks, yeah. So, looking at the future estimated value of my portfolio, if I did nothing but reinvest the dividend payments, in 10 years, my $5,679 investment would have turned into $9,114.51. Let's also include stock appreciation into the equation, which is on average 11% for a total of 16.3% on the year. My $5,679 investment is now worth $22,111, and I'm earning $1,007 a year in dividend payments. Easy money. If this works for you, just keep collecting that easy money. But for me, I have goals, I have passions, I have dreams. So let's talk about my strategy. My strategy based upon my near-term goals is to make enough in dividend payments to pay my bills and responsibilities so that I could quit my job and work on building my own business, which will hopefully get me to my end goal of sitting on the beach with wifey and family, all while planning random adrenaline-chasing adventures all day. Let me first say, work. If you're watching, I love my job, I love the folks I work with, and I am hugely grateful to even have a job during these trying times. Although, I think it's fair to say if you had a decision to sit on the beach all day and get paid versus sitting in your car, in traffic, cussing out all these cell phone driving in the passing lane, slow as all ever chuckleheads, you would choose sitting on the beach. Now, the beauty of my strategy is I do not need to amass enough money to retire today, which would only delay my end goal. I just need enough to survive daily, long enough to start a business such as this YouTube channel that will expedite my progress to that end goal of retiring purely off passive income. I'm only going over my strategy from a high level with a focus on investing a portion of your salary monthly so you can see how much quicker your investment grows. I can seriously dedicate a whole video to my 3 or 4 step strategy. So as we discussed earlier, you want to reinvest your dividend payments so that you can earn interest on interest. Racks on racks on racks, yeah. We saw how easy it was to turn $5,679 into $22,111 simply by doing that. But you also want to dedicate a portion of your income every month to investing. By doing this, your investment grows even quicker. Let's look at an example. Here we invest $100 a month from your salary, which is doable by most everybody. From a starting point of $5,679, if you invested your dividends as well as $100 per month, in 10 years, your account would now be worth $40,860.29 and would be making $1,823.07 a year in dividend payments. Easy money. If you increase that amount as you start to make more money, it grows even quicker. Okay, great. You're making tons of money for doing nothing, but how do I select the right stocks? I purposely saved this for the last as I felt this was the easiest concept to understand. In my portfolio, I have Coca-Cola, Apple, AT&T, the Kraft Heinz Company, Bank of America, and some more risky high-yield dividend stocks, Energy Transfer LP, and Gain Capital Holdings, Inc. This is less about what I am investing in and more about how you select the right dividend-paying company. There are conversations around payout ratio, PE ratio, PB ratio, etc., etc., etc.
Bueller.
All great information and extremely important to understand, eventually. But to get started today and still be safe, all you need to do is the following 4 things. Step 1. Google Dividend Aristocrats, which are companies who have increased their dividend payouts for 25 consecutive years or more. This tells you that these companies have what it takes to go the distance and that it is highly unlikely they will be going under anytime soon. Sorry, wrong image. Step 2, Google successful investor name plus investment profile. In our example, Warren Buffett, Howard Marks, Joel Greenblatt. These are the heavy hitters in the game. If they are investing in a company, there's good reason. Not that these guys can't be wrong, but let's face it, they are a lot smarter than us and they've done a lot more research than we have. This is a safe bet. Step 3, Google top institutional investor plus holdings, or in the same realm, top mutual fund plus holdings. Same concept as number 2, you're siding on big money. They've paid the millions of dollars on research, so you don't have to. Step 4, if you've developed a list of stocks that were in all 3 categories above that are paying out at least a 3% dividend yield, you can perform a last check on the safety of that dividend payout by going to a website such as trackyourdividends.com. No sponsorship here, but they should be. Type in the ticker symbol into the search bar and move over to the Dividend Safety tab, and voila! It has already taken a look at all the technical factors for you and determined how likely that company will be able to continue its dividend payouts. For example, the Coca-Cola company has a dividend safety score of 94, which pretty much ensures the safety of my 3.55% dividend yield. Taking a look at my AT&T position with its 6.84% dividend yield, it holds a 71 dividend safety score, which is still relatively safe, although there are warning signs. Pew, 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 pew. And that, folks, is how you slay dividend investing. There's literally no complication to this at all. Keep it as simple as possible. And before we wrap this all up into a simple 4-step process, make sure you slay that like button, beat on that keyboard like a Neanderthal to leave a comment. Sharing is caring, so let's practice what we preach by sharing this video. And last but not least, subscribe to keep this page alive. I truly appreciate your support. So to summarize, number 1, use Google to find the dividend stock that you will invest into, focus on Dividend Aristocrats, and follow the big money. Number 2, once you've found a list of stock possibilities, go to a website like trackyourdividends.com, which will do most of the technical analysis for you, and select a stock with a good safety score. Number 3, invest, reinvest dividends, and continue to grow your investment monthly with additional investment. Lastly, number 4, hire a tax advisor to help reduce how much Uncle Sam will snatch from your pockets. And with that, folks, I'm Sean McMurray, and this is my channel, Analytical Overdrive. Ayo, yeah!